Afternoon, everybody. I've got with me Clay Markham from PAC Capital and Charles Bagley, one of the advisors from DMG. And the idea of this is that we give a short little clip every month so that you can get an idea of what we're doing for you behind the scenes and a bit of insight into how things are going. So I'll hand over to Charles to get the ball rolling with a few questions of Clay, and we'll get some insight.
Sure. Thanks, Ben. Couple of ones to throw at you there, Clay. Yeah. To start with, global and domestic share markets have really taken off since the start of January, which is great to see. Just interested in your opinion and as to the main reasons behind the uplift in markets and whether you think that run will continue going on.
Yeah, thanks, Ben and Charles, and it's good to be here. And yeah, the markets have had a great start to the year. You know, we are coming off a year last year that markets would like to forget. We all would, but you know, it was a big tech rout and sellout across the world. The Nasdaq down 32%, and there was a lot of carnage around the world, with the thought and thinking that there is a lot of inflationary pressures coming through the world. You know, we've seen the cost of goods going up everywhere, and inflation is hitting 9-7% here in Australia, all around the world. And why have markets kicked away again this year? It's because those numbers that we're seeing are not as bad as markets had hoped, not hoped, but had planned for. So a good example of that is, GDP numbers came out last week in the US. They were expecting 2.6% growth, and they surprised on the upside with 2.9%. You look at non-farm payroll numbers, which is essentially unemployment numbers. People thought that would be circa 205,000. It gets surprised to get on the downside. So they might be small things, but the point is that we are looking for more of a softer landing, or it's not as bad as the market sort of had hoped. So that's why I'm seeing a massive rebound into the markets this year. So it's obviously, you'll see a lot of stuff on the news every night. You know, like the ASX market's up 1% or 2%, or the US market, but you know that won't be reflected in portfolios. There's not a direct correlation between portfolios because we own fixed income and other asset classes as well. So it's been a good start to the year. It's coming off a year that has seen a massive fall around in global markets, and we are cautious but optimistic about this year ahead.
Thanks, Clay. Well, it's good. It's great to hear that and the positive sentiment there as well. So, I guess from a client perspective, for the DMG diversified portfolio and the Clearwater dynamic portfolio, who a number of clients have gotten exposure to, how have they fared during January? Be interested with the market movements.
Yeah, sure. And month of January, we're obviously finishing the numbers now because it's the first day of February. But on the numbers I see right now, the diversified portfolio is up 2.6% on the numbers right now, and the dynamic portfolio is up 3.3 based on that. So that's they're great numbers, and we're really sort of happy and proud of that for clients to sort of see reflected in their portfoses.
Sure, fantastic.
Yes. So, question I've got, Clay, is we sort of, I mean, part of the diversified and the dynamic portfolio, lesser to a lesser extent, is to deal with that volatility along the way. And sort of the last couple of years we've been dealing with this volatility, and I think, you know, going into this year and the sentiment, you know, do you feel? I know we've made some changes in the portfolio. One, for the client's point of view, what were those changes like, as in terms of a bigger, higher level thinking? And why would we make those changes now?
Yeah, sure. And we have such a close relationship with DMG. Like, you guys run our investment committee, and we talk about all these changes and how we see the world. Obviously, with PAC Capital coming in with their Clearwater structure, which is working so well. So, what changes have we been able to make, and why? That was sort of your question.
More around that sentiment of a switch to more defensive to more growth orientated. I guess that's probably where I'm coming from.
Exactly. So the diversified and the dynamic portfolio, not dynamic, sorry, diversified, have always had quite a protective, conservative stance across the portfolio to lower the volatility. It's been the right thing for clients. You know, you've got through these wild times, mitigated the risk and protected capital. You know, like that was been the right thing to do. But now, you know, we can always look at our crystal ball and look back and how we could do things better, how we could have done things better in hindsight. But, you know, that's easy. Now we've got to look to the future and look at what changes should we prepare the portfolios for to capture these results. So, you know, we have made some strategic asset allocations in the portfolio to take more, to add a bit more risk into the portfolios. And when I say risk, I'm not saying they're risky assets. I mean, with that is leaving some more fixed income or stable products and moving into some asset classes, which I'm happy to talk about in depth, is getting some more equity exposure and international exposure and some exposure into some really different asset classes that are not exactly correlated to the ASX 200 or the NASDAQ. You know, some things such as some venture capital or some more private equity investments. Those investments essentially are not correlated to what you see on the news each night on indexes, but we feel it's time for us now to start to take advantage of this cycle and put some money into these different asset classes that are actually quite cheap right now because of what we saw last year. So we have a really good cash position in both portfolios, especially in the diversified, and we're now using our cash reserves to take opportunities in these different sectors that we all agree is the right position for the portfolio. So it's great that been able to get the DMG and the Clearwater portfolios access to all these unique investments. And I'd love to sort of talk about that every week. We do this every time we talk, Chuck and Ben, that about these different asset classes and portfolios.
Well, I think the big thing for me is it's given the portfolios real diversification, and that's really important. And I think I've talked about it a lot with clients in that companies stay unlisted for a long period of time, so a longer period of time than they did 20 years ago. So it is really important to have access to this sector that carries a lot less risk than it did, say, 20 years ago, as an example.
Yeah, it's exactly right. It's become more of a very much a part of portfolios now. People have it used to be very much, and you guys are at the forefront of this. I've only heard of portfolios getting constructed. You have your fixed income, you have your Aussie equities and international, and they actually are quite correlated because if Aussie equities go down, US or international do as well. So now, like, you guys are at the forefront of adding these into portfolios. That's why we work together really well by adding in some more earlier stage private equity and venture capital funds it takes the diversification away from portfolios and adds you a more of a broader spectrum. So it's working really well.
No, it's great.
Yeah, it's great. It's adding more diversification to our clients' portfolios, providing them with an opportunity that isn't easily available outside, if at all. And the ultimate aim is there to put our clients in a better financial position over time. So great to see these incremental changes over time, Clay.
Yeah, exactly, and that's it's nice to add them into this, and I look forward to sort of doing this really consistently. A bit of a market update on the DMG and PAC portfolios, a bit of a wrap. Just for your clients and for you guys, and to sort of add a bit more of a different content piece to your clients.
And I think it's great, Clay, and we appreciate you taking the time out of your day to do it, because you've got a fair bit on, and it is really good that you do it for our clients.
Thanks, Ben.